What if the very institutions designed to protect our economy were actually setting the stage for one of the biggest wealth transfers in modern history? It sounds like a movie plot, but it's happening right now. Central banks are creating trillions of dollars out of thin air. And while they think they're saving the system, they are unintentionally fueling a supercycle in the one asset they can't control: Bitcoin. In this video, we'll break down exactly how their policies are creating a perfect storm for Bitcoin. To get what's happening, you first need to understand the machine at the center of it all: the modern central bank. For decades, we've been told that institutions like the Federal Reserve exist to create economic stability. Their main jobs are to keep prices stable and employment high, and their main tool, controlling the money supply. When the economy slows down, they hit the gas by making money cheap and abundant. When it overheats, they hit the brakes. But over the last 2 decades, this model has completely broken down. It started with the 2008 financial crisis and then went into overdrive during the 2020 shutdowns. Central banks unleashed a policy that used to be considered radical. Quantitative easing, or QE is just a fancy term for the central bank creating new money digitally and using it to buy things like government bonds. The goal is to flood the financial system with cash, push down interest rates, and get everyone borrowing and spending. Let's be crystal clear about what this is. It's not tax money, it's not money that was saved or earned. It's brand new money created with a few keystrokes. The Federal Reserve's balance sheet, which is a good stand in for how much money it has printed, exploded from under $1 trillion before 2008 to a peak of nearly $9 trillion. And it's not just the Fed. The European Central Bank, the Bank of Japan, and the Bank of England all jumped on the money printing bandwagon. This isn't a temporary fix anymore. It's a permanent feature of the system. Anytime there's a hint of crisis or a dip in the stock market, the default response is to fire up the money printers. We saw it in 2020, and the political pressure to do it again is always there. Governments are now addicted to this cheap money. In 2025, the global average debt to GDP ratio rose to an estimated 94.7%. Japan's debt is at a mind-boggling 230% of its GDP, with the United States not far behind at over 125%. How can governments possibly handle that much debt? Only one way: by keeping interest rates artificially low. And how do they do that? You guessed it: more money printing to buy up their own debt. It's a vicious cycle. Runaway government spending is paid for by central bank money printing, which then requires even more printing to keep the whole thing from collapsing. They're caught in a trap of their own making, and that trap has an unavoidable side effect that impacts every single one of us. So why should you care that central banks are printing money like there's no tomorrow? Because every new dollar, euro, or yen they create makes the ones in your bank account worth less. It's simple supply and demand. When you flood the market with an unlimited supply of something, its value drops. We call this inflation, but it's really just currency devaluation. You feel it every day. It's why your grocery bill keeps climbing and why buying a house feels like an impossible dream. It's not that the stuff is getting more valuable, it's that the money in your pocket is getting weaker. This is the silent thief of your wealth. At an average inflation of just 3.5%, $10,000 in savings loses nearly half its purchasing power in just 20 years. The post COVID era was a masterclass in this. Trillions in new money combined with broken supply chains gave us the highest inflation in 40 years. But it gets worse. Look at the housing market. As part of its QE programs from 2020 to 2022, the Federal Reserve became a colossal buyer of mortgage backed securities. In fact, the Fed's purchases were equal to nearly 90% of the growth in eligible mortgages during that time. This fire hose of money was aimed directly at the housing market, pushing mortgage rates to historic lows and igniting a speculative frenzy that sent home prices into the stratosphere. Think about how absurd this is. The very institution in charge of price stability first pours gasoline on the housing market, making homeownership a fantasy for millions. Then, to fight the fire it started, it jacks up interest rates, making mortgages completely unaffordable. It's a cruel 1-2 punch that punishes the average person twice. This is the reality of the system. Your savings are being devalued, the cost of living is soaring, and the goalposts for major life purchases keep moving further away, all thanks to these policies. Your money is melting like an ice cube on a hot day. In this environment, what does any rational person do? They start looking for a freezer. When people realize their money is being systematically destroyed, they don't just sit back and watch. They scramble for an escape hatch. They start a frantic search for a safe haven asset, a place to park their wealth that can't be inflated away. This is the moment capital starts fleeing the melting ice cube of fiat currency, looking for a solid lifeboat. For centuries, gold was the go-to lifeboat. It's rare, it's durable, and governments can't print it. But gold has its own issues. It's heavy, it's hard to move around, and its total supply isn't perfectly transparent. What about the other usual suspects? Stocks? While stocks can offer a hedge against inflation, they're tied to the very system people are trying to escape from. A huge chunk of the stock market's gains has been fueled by the same cheap money from central banks. When the money printer slows down, those stock market bubbles can pop violently. Bonds? In a world of rising debt and high inflation, buying a government bond is like lending money to someone who has promised to pay you back in a currency they are actively devaluing. It's a guaranteed way to lose purchasing power. Real estate has been a classic store of value, but as we just saw, it can be directly manipulated by central bank policies, leading to massive bubbles and affordability crises. So, where does that leave us? The traditional lifeboats are all leaky, slow, or tied to the sinking ship. This is the critical point we're at today. Trillions upon trillions of dollars, held by everyone from individuals to massive corporations, are being pushed out of traditional currencies and assets. This capital is now on a desperate search for a new home, a new safe haven that is truly outside the old system. And that search is leading everyone to the same place. This is where it all clicks. Born from the ashes of the 2008 financial crisis, a new solution emerged, specifically designed to solve the problem of currency debasement. That solution is Bitcoin. To understand why Bitcoin is the ultimate answer to the mess central banks have created, you only need to grasp one thing: absolute scarcity. Bitcoin has a fixed supply of 21 million coins. That number is hard coded into its DNA. There will never, ever be more. This isn't a policy promise that a committee can break, it's a mathematical certainty enforced by a global, decentralized network of computers. Let's put that side by side with the system we just talked about. The Federal Reserve can create trillions of dollars with a few keystrokes. Their supply is infinite. Bitcoin's supply is finite and predictable. This single feature makes it a total game changer. It's the perfect antidote to the poison of endless money printing. While central banks are frantically cranking up the printers, Bitcoin's code is calmly issuing a smaller and smaller amount of new coins on a schedule that was set in stone from day one. This event, known as the halving, happens about every 4 years, making Bitcoin scarcer over time. But its fixed supply is only half the story. Bitcoin is also decentralized. There's no CEO to fire, no board of directors to pressure, and no central office to shut down. No government can change the rules or decide to create more of it to bail out their friends. It's the first truly sovereign asset the world has ever seen, owned by its network of users. On top of that, it's a global permissionless network. You can send billions of dollars worth of Bitcoin across the planet in minutes, 24/7, with no bank required. It's like digital gold, but better. You can't build a payment app on top of gold bars in a vault. You can't instantly send a fraction of a gold bar to someone on the other side of the world. With Bitcoin, you can. It combines the scarcity of gold with the speed and utility of the internet. Now, some critics say Bitcoin isn't a perfect hedge against inflation because its price doesn't move in perfect lockstep with the Consumer Price Index, CPI, but that misses the entire point. Bitcoin isn't a hedge against last month's grocery bill. It's a hedge against the system that makes your grocery bill go up. It's a hedge against monetary expansion and the central bank policies that create inflation in the first place. When central banks print money, capital flows into Bitcoin precisely because investors see it as the ultimate escape. It is the only asset that provides a credible, verifiable, and unbreakable promise of scarcity in a world drowning in infinite paper money. It is the lifeboat. By the way, if you're finding this breakdown valuable and want to stay ahead of these massive economic shifts, do me a favor and hit that subscribe button. We tackle these complex topics every week to give you the clarity you need in a fast-changing world. Now let's get back to it. So we've got the problem. Central banks are trapped in a debt and money printing spiral. We've got the consequences. Your wealth is being systematically devalued. And we've got the solution. Bitcoin, an asset with an unbreakable promise of scarcity. Now let's put it all together. What's happening isn't just another 4-year Bitcoin cycle. This isn't just another bull market. We are entering what many are calling a Bitcoin Supercycle. A longer, more powerful, and more sustained period of growth, driven by a fundamental seismic shift in the global economy. The catalyst is the synchronized worldwide devaluation of fiat currencies. In previous cycles, maybe one or two major economies were printing money. Today, it's a global party. From the US to Europe to Japan, major central banks are signaling a move toward easier money, with rate cuts expected throughout 2025 to manage the colossal mountain of global debt. This creates a massive push factor. Capital isn't just being attracted to Bitcoin, it's being pushed out of every other asset by the corrosive force of inflation. It's a flight to safety, but the definition of safety has fundamentally changed. Safety is no longer a government bond that guarantees you'll lose purchasing power. Safety is now provable scarcity. This brings us to the pull factor. Bitcoin is finally growing up. The launch and wild success of spot Bitcoin ETFs in 2024 was a watershed moment. It was a green light for the most conservative, deep pocketed investors in the world, pension funds, corporations, and even sovereign wealth funds, to finally enter the market. And the numbers are just staggering. As of October 2025, institutions and ETFs had already purchased many times more Bitcoin than was being newly mined. Think about that supply and demand shock. The demand from these new institutional players is already at times swallowing up several times the amount of new Bitcoin being created, and that's after the 2024 halving already cut the new supply in half. This is the perfect storm. On one side, you have central banks actively torpedoing the value of their own currencies, creating a tidal wave of capital looking for a safe harbor. On the other, you have Wall Street finally building the regulated bridges for that tidal wave to flow directly into Bitcoin. Bitcoin has graduated. It's now a true macro asset, a primary way for investors to express a view on the future of global monetary policy. The supercycle thesis is simple. As long as central banks continue down this path, and with global debt levels where they are, they have no other choice. The flow of capital into the world's only provably scarce asset is not only inevitable, it's just getting started. This supercycle isn't just a theory. The evidence is everywhere, and it's growing by the day. The smart money, the institutional investors who were once the biggest skeptics, are now leading the charge. Just look at the flows into Bitcoin ETFs. As of late October 2025, US spot Bitcoin ETFs held a colossal sum, with assets under management estimated to be in the range of $148 billion to $154 billion. These aren't small retail bets. This is a massive strategic reallocation of capital from the heart of traditional finance. And it's not just exchange traded funds. Publicly traded companies are now holding over 1 million BTC on their balance sheets as a way to protect their corporate treasuries from devaluation. More than 170 public companies now hold Bitcoin. Tracked entities, including public and private companies, ETFs, and even governments, now collectively hold a significant portion of Bitcoin's total supply. This institutional embrace is global. We're seeing regulatory frameworks solidify in places like the European Union and Hong Kong, which gives even more large-scale investors the confidence to get involved. The shift in attitude is almost comical. Jamie Dimon, the CEO of JP Morgan Chase, who famously called Bitcoin a fraud back in 2017, now oversees a bank that allows its clients to invest in it. In a major reversal, Dimon acknowledged in late 2025 that Bitcoin is real and will be used, a sign that even the biggest skeptics are being forced to face reality. Analysts are taking note. While some predict short-term pullbacks, long-term price targets for Bitcoin are becoming increasingly bold, with many setting sights on $150,000 to $250,000 in the coming cycle, driven by these powerful macro trends. What this all points to is a fundamental change in Bitcoin's role. It has graduated from a speculative gamble to a strategic reserve asset for the world's largest pools of capital. The idea of Bitcoin as a hedge against irresponsible central banking is no longer a fringe belief. It's an investment thesis being actively deployed on Wall Street. As this institutional wave builds, it creates a powerful feedback loop. More demand leads to higher prices, which leads to greater legitimacy, attracting even more demand. This is the engine of the supercycle, and it's firing on all cylinders. Let's bring it all home. Central banks are locked in an irreversible cycle of money printing, driven by unsustainable government debt. This isn't a temporary glitch. It is the system now. This relentless devaluation acts as a silent tax on your savings, eating away at your wealth year after year. In response, a great migration of capital has begun. Smart money, from individuals to the largest institutions on the planet, is fleeing the melting ice cube of fiat currency, searching for a real safe haven. They're looking for an asset that can't be manipulated, censored, or printed into oblivion. That search is leading them directly to Bitcoin. With its mathematically guaranteed fixed supply, its decentralized network, and its growing global acceptance, Bitcoin represents the only credible escape hatch. This isn't just another bull run. The combination of unprecedented global money printing and the opening of institutional floodgates has created a perfect storm, a Bitcoin supercycle. The demand shock from Wall Street is colliding with the biggest supply shock in Bitcoin's history. We are living through a pivotal moment. The very nature of money is being redefined before our eyes. The choice is becoming crystal clear. You can stay in a system of centrally controlled, infinitely inflatable currency where your wealth is guaranteed to lose value over time, or you can opt into a decentralized, global, and provably scarce monetary network designed to protect it. Central banks may not have intended to create the greatest advertisement for Bitcoin in history, but that's exactly what they've done. Their actions aren't just fueling a bull market, they are fueling a fundamental reevaluation of money itself. The biggest wealth transfer of our lifetime is underway. The only question is, which side of it will you be on? If you want to dive deeper into how these macroeconomic forces are shaping the future of finance, check out this other video on our channel right here. And don't forget to subscribe and hit the notification bell so you never miss an update. Thanks for watching.